All right, hi everybody. This is Dr. Manning, and this is going to be Insurance 101. So basically, what this is going to be is a basic breakdown of different types of insurance and some of the more important terms to know when it comes to insurance. So, insurance is certainly not a very exciting topic. It's not something that people like to think about very often, but it is incredibly important, especially as you become older and you have more people depending on you and you get a more established life, you get married, you have children, you have a job, all of those kinds of things. Once that happens, insurance becomes incredibly important to you. So we're going to talk about some of the different types of insurance and, like I mentioned before, some of the key terms. All right, so let's start off with one of the key terms. What exactly is insurance? So basically, insurance is when you pay a company, and there's a lot of different types of insurance companies, but you pay a company to provide coverage to you if something bad happens. And it kind of depends on what type of insurance you have, will depend on the type of coverage you get, and it has to be like a certain bad thing. So we'll talk a little bit more in detail about that in a moment. But you can see by the definition here, it's an arrangement between you, the individual, and the company that protects you from risk. And insurance is big, big business. In fact, in the United States, 1 out of every $12 that is spent on insurance. So that's a huge part of our economy. But we do this for peace of mind and to protect ourselves because unfortunately bad things happen to everyone. So when they do happen, we want to make sure that we can bounce back from it, that we can persevere. Okay, so 3 important terms related to insurance, and these are all part of your insurance policy. So a policy is a fancy word for contract. It's the contract between you and the company, all right? But they call it a policy. And when you enter into a policy, there's going to be 2 things that you have to pay. So thing number 1 is the premium. And this is your payment that you give to the insurance company to protect yourself. And this premium can be given to them once a month. Some people pay their like car insurance once a month, or it can be something that is given to the insurance company maybe every 3 months, every 6 months, or some insurances are paid just once a year, like homeowners insurance. But regardless of how often you pay it, the premium is how much you pay, and it's to cover your cost. Now, there's this other thing called a deductible. A deductible is to sort of help protect the insurance company. It's to keep people from constantly claiming that bad things have happened to them. And what I mean by that is when something happens, let's say you get into a car accident and you want your insurance company to help fix your car, you have to pay an amount up front, and that amount is called a deductible. So the insurance company will say, okay, well, we're going to fix your car, but you have to give us $500 first, which is your deductible, and then we will cover the rest of it. If insurance companies did not require a deductible, there would be an incentive for people to constantly ask the insurance companies to fix things or to pay for things. Even really, really minor things, like I get a scratch in the parking lot. Oh, I'm going to turn that into insurance so that they can fix it. It just wouldn't make sense. So that's why we have deductibles. All right. So here's a quick little example. You pay money to have car insurance. That's your premium. When you get into accidents of some kind or you get hurt, you pay them a deductible and then they pay the rest. And then finally, the way that premiums and deductibles work together is the higher deductible that you're willing to have, the lower your premium will be. So if I don't think that something bad's going to happen to me, I might want to have a high deductible, because that way that premium, the money that I have to pay no matter what, I will have a lower monthly payment. All right, let's get into some of the more common types of insurance. So there's a lot of different types of insurances, but I think for a high school student, these are probably five that you need to be familiar with. Some of these you might already have, like automobile. If you're currently driving, I hope you have automobile insurance because it is required by the state of Missouri. And if you don't have automobile insurance and you get pulled over, you will get into quite a bit of trouble. So want to make sure you have that. Health insurance, that's also a very important one. Life insurance is important, but for a high school student, it's probably not one that they currently consider. Disability and homeowners are kind of the same thing. You guys are just in a current spot in your life where these three types of insurances are probably not incredibly important to you, but they will become important to you later in life. So let's talk about the ones that are currently important to you. In fact, let's discuss automobile insurance. Okay, so automobile insurance can be a little complicated because there are different types of automobile insurance within your one policy. Remember, policy is the contract you enter in with your insurance company. So let's start with liability. Liability is the one that is absolutely required by the state of Missouri. You cannot drive a vehicle in Missouri legally if you don't have liability insurance. And here's what liability insurance covers. The other people. It does not cover you. So let's imagine that you are driving your car and you aren't paying attention, you're texting, or you look down at your phone, or you're distracted by a friend, whatever, doesn't matter what happened. But you get into a car accident and the police say it was your fault. Liability insurance will pay for the other person's car and the other person's medical expenses if they end up getting hurt. And it will also pay for your court fees if it comes to that. So this one does not help you specifically, it helps the other people that you might have hit or injured. But this one's required by law because the state of Missouri says, well, if you're going to drive a vehicle, you need to be able to pay for the damage that you cause. Okay. Now, the other three, even though they're not required by law, they are highly, highly, highly recommended. So medical payments would pay for anybody that is riding in your vehicle, including yourself, if you get hurt. So you get into an accident, the police say it's your fault. Medical payments pay for you and anybody riding in your vehicle to go to the hospital. You might be thinking, but what if it's the other person's fault? Well, if it's the other person's fault, then their liability insurance will pay for your medical expenses. Okay, uninsured motorist. Let's imagine that you get hit, it's the other person's fault, but they're not a very responsible person and they don't have insurance. So first of all, the police are probably going to, issue them a ticket, might even take them to jail depending on what kind of accident it is. But then you're stuck because they don't have insurance to pay for your bills. Uninsured motorists will then come into play. So if you get hit by somebody that does not have insurance and it's their fault, your uninsured motorist will cover your expenses. And then finally, collision and comprehensive. So collision is you hit another vehicle, it's your fault, it pays for your car. Comprehensive is any damage that is done that is not related to driving. So one of the most common ones is like storm damage, hail damage. So maybe there's a big storm, a tree falls on your car. That's comprehensive. There's a flood. Theft and vandalism, maybe that one is one that comes up a lot of times. Your car gets broken into. Important things get stolen out of it. Your comprehensive would pay for that. Your windshield gets damaged. There's all sorts of things that comprehensive would pay for, but it's those things that happen to your vehicle when you're not driving it. Okay, so how is the price of automobile insurance determined? Well, there's a whole bunch of things that go into the cost, and almost nobody pays the exact same amount for their car insurance because nobody has all of these exact same things. So your age is important, and I'm sorry for you guys, but younger people pay more. Your gender is important. Sorry, fellas, but guys pay more. Where you live and what you drive is important. If you drive a brand new $80,000 Ferrari, your car insurance is going to be really expensive. If you drive a beat up pickup truck that is used, your car insurance won't be nearly as expensive. Your driving record, have you been in accidents before? And then there's some other things as well, marital status. So all of these things added together create how much your automobile insurance costs. Okay, let's get into health insurance. So health insurance is also a really important one. Hopefully you are currently covered health insurance. Most likely you are covered under your parents' insurance policies, but this covers anything that if you get sick or you get injured in some way. So you have to go to the doctor, you have to get a prescription, you have to have some sort of surgery, you have to go to the emergency room, even if you have like dental or eye issues. All of these things would be covered by your health insurance. So most people get their health insurance from their employer where they work at. If your employer doesn't offer it or you don't work enough hours or whatever, then you can also get health insurance through the government. You can go to healthcare.gov and pick out an insurance policy that works for you. For you guys, you are probably covered under your parents' insurance. In fact, children can be covered all the way up until the age of 26. So it doesn't matter if you're living at home or not. It doesn't matter if you're going to college. If your parents have insurance and you don't have access to insurance, they can get you on under their policy. Of course, it's going to be a little bit more expensive for them, but they can do that all the way up until the age of 26. When you turn 27, the government basically says, well, you should either have a job that gives you insurance or you need to go to healthcare.gov and pick out your own insurance. Okay, these last few I'm going to go through fairly quickly because, like I said, they're important, but maybe not to you right at this very moment. So life insurance is if someone dies and you get your family or whoever you choose to get your policy, but whoever you choose, they get a payment. And there are different amounts. You can have life insurance policies that'll be like $25,000, $100,000, even millions of dollars. And if you pass away, your family members or whoever you choose, they get that money. And they can use that money for anything they want. They can use it for funeral expenses. They can use it for regular everyday bills, paying off houses, those kinds of things. So this becomes important to people once you have a family, once you get married, once you have children, and you would want these people to be taken care of in case if you passed away. Disability insurance is if you get injured or sick and you cannot work. Of course, if you can't work, you don't have any money, right? And you need money to survive, to pay bills, to buy food, clothing, etc. So what disability insurance does is if you are determined by a doctor that says you cannot work because of health reasons, they will pay a percentage of your salary. Usually the percentage is somewhere between like 60 and 70%. They don't give you 100% because then there would be no incentive for you to get healthy and start working again. But they usually give you enough that you can get by. And hopefully disability is not something that's long-term. Unfortunately, it is for some people. But hopefully disability can be something that only lasts maybe a few months or a year, and then you're healthy again enough to go work. Okay, and then finally, homeowners and renters. So homeowners is if you actually purchase your house, and renters is if you're renting. And renters is probably going to be the one that'll be most relevant to you in the short term, because most of you will rent before you buy a home. That's just generally how it goes. These two insurances cover things that happen to your house. It could be damage, fire, theft, natural disasters, and so on. They cover the structure of the home if you own the home, and they also cover the things that are inside the house if you are the homeowner or the renter. One thing that usually gets bypassed, though, is that it also will cover you if anybody were to sue you. So they get injured on your property and they sue you. Last thing, homeowners insurance is required by law if your bank purchases your home for you. So if you get a mortgage to buy a home, it is required. Okay, guys, see you later.